Can you imagine working 80 hours a week on Wall Street, surrounded by experts who are racking their brains trying to beat the S&P 500? Well, surprisingly, more than 90% of those professionals fail to beat this index in the long run. What does this mean for you and me? What? Basically, the S&P 500 is not just a key indicator of the US economy, but also one of the best places where we can invest our money. However, a common question always comes up: how can I invest in the S&P 500? And clearly, the easiest way is through ETFs or exchange-traded funds. But from there, another question arises: what is the best ETF to invest in the S&P 500? And with so many options in the market, it's easy to get confused and not know where to start. That's why in this video, I'm going to show you the main ETFs that track the S&P 500, its main features, and the reasons why you might lean towards one or the other. The best thing is that no matter which one you choose, everyone seeks to emulate it. The same goal: to reflect as accurately as possible the performance of the 500 largest companies in the United States. The big advantage of investing in the S&P 500 is diversification. Having the biggest and most established companies on your investment roster, not just from the US market, but from around the world. Since we know that the US owns many of the largest companies in the world, if you will pardon the redundancy. However, since there are multiple funds that track the same index, it might seem redundant to buy more than one at a time. Many people wonder if it's better to have several different S&P 500 funds to diversify even more. In reality, if they all replicate the exact same index, you'd be doubling the same exposure without any additional benefit. So, if the important thing is to choose a single ETF or fund that offers you stability, a good track record, and low fees, we need to consider several key factors. First of all, there are the fees, known as the expense ratio. This percentage, even though it seems minimal, can significantly cut into your profits. Considerable over the years. For example, a 0.09% fee versus a 0.02% fee may seem insignificant today. But after 20 or 30 years, the differences in final returns are astonishing. Secondly, we need to look at liquidity and the creation date. An ETF with high trading volumes gives you the ability to buy and sell with ease. In turn, an extensive performance history. It helps us see how the fund responds during boom times and in times of crisis. Finally, the amount of assets under management, also called AUM. It tells us the magnitude and confidence that investors place in that specific investment vehicle. But before breaking down each of the funds and ETFs that replicate the SP 500, we need to quickly review why this index is so popular and important. In the world of investing, it's not just about throwing your money in for no reason. You really want to do it based on knowledge. The S&P 500 includes 500 leading companies that represent about 80% of the market capitalization of the US stock market. This means that with just one investment, you're tapping into the potential growth of iconic brands like Apple, Microsoft, Amazon, and many more, companies that drive the global economy with their size and influence. History shows us that since its launch in 1957, the S&P 500 has delivered average returns close to 10 or 11% annually over the long term. Of course, this is an average. There are years of big gains and others of losses, but the historical trend has been positive. In fact, many professional traders who try to beat the index end up falling behind after a few years. We cannot invest directly in the index because it is not an activity. It's not a financial asset in itself, but rather an indicator. To address this, there are mutual funds and ETFs that replicate its components by buying the stocks with the same weight that each company has within the S&P 500. The main difference between an ETF and a mutual fund or index fund is how they are traded and their potential tax advantages. An ETF is traded on the stock exchange and can be bought or sold throughout the day, just like a stock. In contrast, a mutual fund is only valued once a day after the market closes, and you usually don't find it on all platforms, but rather in the management. that created it or at brokers that have an agreement with it. Which one is better for you? If your approach is to buy and hold, there really isn't much difference in the long run. However, ETFs tend to be more tax efficient and often have lower fees in some cases. Now, if you prefer the simplicity of a mutual fund and your broker offers it to you without any extra costs, that's totally valid too. By the way, to invest in these specific ETFs that we're going to be discussing, I'll leave the links to the brokers in the description where you can find them, or maybe you'll find alternatives directly to them. So, in the description and in the first pinned comment, I'll leave the links to these brokers. Now that we've talked about all this, we can start with the ETFs. The first on the list is the Vanguard SP500 ETF, or by its ticker VOL, one of the most famous in the world. Why is that? First, because Vanguard was a pioneer in index funds and its founder, John Bogle, laid the groundwork for passive investing. VOL stands out for its low fee, as we mentioned earlier, also called expense ratio, of around 0.03% and a massive volume of assets under management totaling over $900 billion. Its liquidity is high, and you can buy it practically at any broker. Historically, VOL has provided returns very close to the index and issues a dividend that hovers around 1.3% to 1.4% annually, depending on market fluctuations. The second one is the SPDR, SP500, ETF. Trust, or by its ticker SPY. It's the oldest and one of the largest in the world. Created in 1993, it has an expense ratio close to 0.09%, which is higher than Vanguard's, but its liquidity is monstrous. SPI moves huge amounts of money every day, so it is preferred by investors who trade frequently or do intraday trading. However, if your plan is to buy and hold for several years, you might benefit from lower fees that other alternatives offer. Thirdly, we have the iShares Core, SP500, also called by its ticker IDV, offered by BlackRock, and IDV also charges very low commissions of 0.03% and is the second largest option in terms of sizes after SPY. On the other hand, it does not have the same monstrous liquidity as the SPY, but for a long-term investor who doesn't do daily trading, that shouldn't be a problem. Its returns have been in line with the index as expected, and its dividend is competitive, hovering around 1.2% to 1.4%. The fourth option now in the ETFs is the SPDR portfolio, SP500 ETF. I know they have a pretty long name, but that's why I'm leaving each of the ETFs on the screen for you. That is to say, in this case, by its ticker it's SPLG. This belongs to the same family as the SPI, but was created to compete in costs. It has an expense ratio of just 0.02%, which makes it very attractive if you are looking for a minimum commission. Plus, its price per share is lower than that of the SPI or the B, or what may interest those who do not have access to buy fractions of TF. Despite the fact that it is not as immense as the SPI, it maintains a substantial level of asset, and in terms of profitability, it seeks to tie the SP500 like the others. In summary, which one to choose if you are one of those who trade in assets? S is the king of liquidity to enter and exit constantly. Now, if your style is to buy and hold for a long time, and you want to minimize commissions, the best options are the VO and VO. The SPLG, since these are excellent. They all replicate the same index, so their performance graphs are almost identical in the long term. The nuances arise in the cost structure and the ease of purchase. That's why you should check with your broker or the platform where you invest to see which of these is available for you to invest in. If you have any further questions about investing in ETFs or investing in the stock market, please leave them in the comments section, and in the future we will make a video about the questions in this video. See you. Bye bye.